What are financial statements? Financial statements are formal records of the financial activity and position of a business person or other entity. They are written records that convey the business activity and financial performance of a company. Financial statements are often audited by government agencies, accountants, firms, etc. to ensure accuracy and for tax, financing or investing purposes. Typically, financial statements include balance sheet, income statement and cash flow statement. But today in this video we're going to talk about balance sheet. So if you are here looking for understanding the balance sheet of any company from investing perspective, then you might have got the right place to visit in. Hello everyone, welcome to our YouTube channel. My name is Rishabh Mandal and you are watching Random Research Center. Though we are not discussing the other two terms, but we will also see them in brief. But today our main focus will be on balance sheet. So as mentioned earlier, financial statements include balance sheet, income statement and cash flow statement. Now moving to our topic, that is balance sheet. Balance sheet is a financial statement that reports a company's assets, liabilities and shareholder equity at a specific point in time. Simply it provides a snapshot of what a company owns and what a company owes, as well as the amount invested by shareholders. Fundamental analysts use balance sheet in conjunction with other financial statements to calculate financial ratios. Examples: current ratio, debt to equity ratio, etc. In balance sheet, accounts of capital and liabilities are shown on the left hand side, known as liabilities, and assets and other debit balance are shown on the right hand side, known as assets. There is no prescribed form of balance sheet for a proprietary and partnership firm. However, Schedule 3, Part 1 of the Companies Act 2013 prescribed the format and the order in which the assets and liability of a company should be shown. But we will not go in that depth. We will just see what the term means, how it works, and also how useful it is for us. Moving ahead. Till now we think you must got an understanding what the balance sheet is. So now let's discuss about the formula adheres by a balance sheet. The formula is intuitive. A company has to pay for all the things it owns, which is assets, by either borrowing money, taking on liabilities, or taking it from investors, issuing shareholders equity. So now if you see the example, you will understand what I'm trying to say. Suppose a company takes out a 5-year loan from a bank of 4 lakh rupees. Its assets, specifically the cash account, will increase by 4 lakh. Its liabilities, specifically the long-term debt account, will also increase by 4 lakh, balancing the both sides of the equation. Now if the company takes 8 lakh rupees from the investors, its assets will increase by that amount, as will its shareholders equity. So if you had noticed, both sides of the balance sheet, assets and liabilities, are always balanced, which goes with formula: assets equal liabilities plus owner's equity. That means whatever the total amount comes on asset side, that amount is always equal to the liabilities side, hence balancing the both sides. And that's the reason why it is called as balance sheet. Now before we talk about the item included in the balance sheet and how to read it, let's take a look on the other two terms also: income statement and cash flow statement. What is income statement? Income statement is a financial statement that summarizes the revenue, cost and expenses incurred during a specific period, usually a fiscal year or quarter. It is also known as profit and loss statement. In simple words, it shows how much profit or loss was generated by a business. Income statement is one of the 3 financial statements every public company issues quarterly and annually, along with balance sheet and cash flow statement. And now moving to our next term, that is cash flow statement. What is cash flow statement? Cash flow statement is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. Simply, the cash flow statement is concerned with the flow of cash in and out of the business. It includes only those revenues and expenditures that have been realized in an accounting period. Both income and cash flow statement deserves a separate video, and currently we are working on it. And as soon as this video has been published, we promise you that we will continue to upload those 2 videos also one after one. Now moving to our main topic, balance sheet. So now let's talk about the item included in the balance sheet and how it works. The balance sheet accounts whatever the money comes into the company and stays or leaves the company in any form, be it tangible or intangible. Given below the major subhead of the same, which will make it easier for you to understand the balance sheet format. As mentioned earlier also, balance sheet is divided into two categories, assets and liabilities. So first we will talk about assets. Now under it comes first current assets. What are current assets? Current assets are those assets that can be liquidated, means can be converted into cash within a financial year. Examples of such assets include inventories, trade receivables, cash and more. Now the second, it comes non-current assets. What are non-current assets? Broadly, non-current assets are those that cannot be liquidated or converted into cash within a financial year. These are also known as fixed assets. Fixed assets have few categories under it, like tangible assets, machineries, vehicles and likewise. Intangible assets like goodwill, long-term loan and many others. On the second, it comes liabilities. With liabilities, there are two broad categories, and one of the most important ones that carries a lot of significance in a company's balance sheet is shareholders' equity. First, shareholders' equity. Shareholders' equity is the money attributable to business owners, meaning its shareholders. It is also known as net assets, since it is equivalent to the total assets of a company minus its liabilities. Shareholders' equity equal assets minus liabilities. Shareholders' equity basically can indicate the book value of a company. Now the second, it comes current liabilities. What are current liabilities? Current liabilities are those liabilities which has to be paid within a financial year. This includes payment pending to suppliers and vendors within a short time period. Tax payable to government, salaries, dividends payable also falls under current liabilities. Now the third, it is non-current liabilities. Non-current liabilities are those liabilities which has to be paid after a financial year or more. Longer term borrowing and deferred taxes are examples of some non-current liabilities. We have made a video on assets and liabilities which you can definitely check out. The link will be provided in the description. Now, as you can see, we have two types of balance sheet of Tata Motors. First one is standalone balance sheet and second one is consolidated balance sheet. So obviously the next question will be, what is the difference between them? Whenever a company publishes its quarterly or annually results, you will see two types of balance sheet that a company publishes: standalone and consolidated. The difference is very simple. Standalone balance sheets are those that have collated the statement of only the holding company, whereas consolidated balance sheets indicate the financials of the holding company along with its subsidiary companies as well. In this case, in consolidated balance sheet of Tata Motors, its subsidiary companies are Jaguar and Land Rover. We will always advise you to consider the consolidated balance sheet for fundamental analysis, not standalone. Thus, standalone is to know how its prime business is doing, but consolidated will give the complete picture of the company. Now lastly, where you will find all these statements. For this, you can use some apps or websites like Money Control, Tickertape, Investing.com, etc. We'll provide you the link in the description where you can definitely check this out. Let's talk about some limitation of the balance sheet. The balance sheet is an invaluable piece of information for investors and analysts. However, it does have some drawback. Since it is just a snapshot in time, it can only use the difference between its point in time and the another single point in time in the past. Because it is static, many financial ratios draw on data included in both the balance sheet and the more dynamic income statement and cash flow statement to paint a fuller picture of what's going on with the company's business. From an investor's point of view, while analyzing the company for its financial performance, learning to read a balance sheet can give you a vital insights and aid your investments decisions.
So finally, thank you for watching. Hope you learned something new today. And if yes, then hit the like button and smash that subscribe button. See you soon in the next video. Till then, Jai Hind.